Hello friends, welcome to the April edition of Monthly Viewpoints. Fiscal year 2019 ended on a positive note. Last year, we had seen a sharp fall in the markets due to heightened volatility driven by both global macro developments as well as domestic events. However, we have seen a rapid recovery this year led by a dovish Fed, optimism on resolution of US-China trade war talks, and lastly, a strong anti-terror response by the Indian government which seemingly has boosted its chances in the upcoming general elections. Overall, we are positive that India is on a strong wicket for FY20 and beyond. Globally, we have seen a positive change in the narrative in 2019 versus in 2018. In the face of slowing growth in the US, the Fed has slowed its rate hike projections and may even end its quantitative tapering program earlier. The change in stance of the Fed has led to hopes that the US economic cycle has reached a so-called benign equilibrium wherein GDP growth slows down to a trend level of 2% and still manages to avoid a recession as indicated by an inversion of the yield curve. Globally, most of the central banks have become dovish, and this has opened up space in the emerging markets for a rate cut which will boost their economies. Another positive development is that the uncertainty related to the trade war should end soon as the US and China are close to a resolution. Lastly, although Brent crude prices have rallied almost 30% to reach levels of $70 to a barrel, this is still manageable by oil importing emerging economies like India, and our current account deficit should not be too adversely impacted. Considering these developments, we have seen an improvement in emerging market sentiment, and there has been a strong rally led by strong FPI inflows into emerging markets as fund managers correct their light positioning. India alone has seen more than $7 billion in inflow in equities in the Jan to March 19 period. Coming to domestic markets, external stability is less of a concern now as both the crude oil and rupee are range bound. Until now, the economy was in a phase of fiscal consolidation and tight monetary policy. However, the fiscal deficit is being managed and monetary policy is easing as seen by the 25 basis points rate cut by the RBI. This should provide some space for the economy to grow. With the RBI implementing innovative measures like the rupee-dollar swap, liquidity should no longer be an issue, and we believe that system liquidity will be back to neutral by May-June post the elections. Credit growth continues to remain strong and should support domestic growth. Although the RBI has reduced FY20 GDP growth projections by 20 basis points to 7.2%, this is still relatively higher than other major economies. With rising incomes, the way Indians spend is changing, and discretionary consumption should drive India's growth going forward. The rural economy has seen some stress for some time, but election spending and DBT should provide some stimulus in the short term. We have seen some weakness in the auto numbers over the past few months as costs have increased because of rising insurance premiums and manufacturers have raised prices due to a change in technology. An overestimation of demand has also led to an inventory build-up. However, in the past, we have seen that the demand for high-ticket discretionary items does get impacted just before elections. However, we do not believe that this is a structural showdown and think that this situation should get normalized post-elections in the next couple of quarters. Coming to our view on the markets, we remain constructive on India's overall economic growth and believe that the broader market earnings should remain supportive. The Nifty is currently valued at a one-year forward PE multiple of 18.5 times, which is slightly above its long-term average. However, the valuations for the broader market could offer reasonable returns for long-term investors. Global macro conditions have stabilized and the market is giving higher chances for the incumbent government to come back post the elections. This has led to confidence coming back to markets. This was reflected in the sharp rally we have seen in the past few months, especially in the mid and small cap space. We believe that the market will make a decisive move post the elections and the Q4 earnings season after May. We suggest that investors continue to build equity exposure for the long term and also recommend that investors use SIPs or STPs over the next 6 months. It would also be advisable for investors to allocate 20% of their corpus to mid-cap and small-cap funds as valuations in that space are still attractive. Select themes we are participating in are consumption, which includes the consumer and consumer discretionary sectors, financials, which includes private banks, corporate banks and select NBFCs, and industrials, which includes capital goods. We offer a basket of suitable funds for investors to choose from. Thank you and happy investing.